the market right here in 80 now with me, Aisha Faridi, Nikunj Dalmia in the studios. And Wall Street has ended a little bit lower, but you are seeing the set of world markets actually breathe a sigh of relief. Now that there are tariff uncertainties, Trump has said that he's going to push back on the implementation of tariffs and delay them. And that's definitely bringing about a little bit of a sigh of relief. Canada, Mexico, all those tariffs were something that was supposed to be executed immediately. So that's something that is now a little bit of a relief. But again, it seems like it's going to be temporary in nature. With Trump, I guess you can keep second guessing what his next move is going to be and then how the markets are going to react to that.
Yeah, it's strange but true. That's the way it is. At the same time, yesterday the news flow was different. Suddenly looks a lot different. It may change again. And this is making financial markets confused. There are pockets of risk-on activity, and similarly there are pockets of bouts of short covering which clearly are visible. Asia on expected lines, it's not bounced back completely because markets know that something or the other is coming. It could be a diluted manner, it could be in a selective manner. So whatever collateral damage we saw for Asian markets yesterday, a lot of that collateral damage is yet to be undone. So as we walk into trade this morning, it's looking better, but better does not make markets very predictable, because this kind of a news-driven volatility, if at all, I think is just going to add to volatility and it's just going to keep market guessing. What you don't want is, what markets don't want is that they don't want to keep on guessing. And both locally and globally, I think that really seems to be the narrative, Aisha. In India also, we're just moving from one event to the other event. First, it was really centered around Donald Trump's inauguration, and then the world would be a better place, or world would be a predictable place. Then we all thought, okay, let the Fed go through, markets in a sense would be able to get a directional move. Then it was budget, which has also come and gone, and now everybody is talking about RBI. So that is the nature of the market, that the desire to buy and the desire to trade is missing. The appetite to buy is not there, and markets are making an excuse. In life you make an excuse sometimes. Oh, why haven't you done this? This went wrong, that one went wrong. So markets are making an excuse. First it was...
You're really used to it now. All of us give you excuses all the time.
No, it's just human nature. Human nature. So markets may be same. It's human nature ultimately, making an excuse. Why are markets not going up? Oh, it's because of RBI. Oh, why not?
And in markets, it's always the reasons that follow. So, you can now put any math to it.
Exactly.
Yeah, but anyway, having said that, you're seeing a little bit of relief, at least for the US futures now. Of course, overnight, the markets did crack quite hard. You were still down about almost 1% odd, 1.25% across the board. But yeah, the pre-market rates are indicating a little bit of stability, at least, if not a big jump up. Asia this morning, that's also sort of seeing a sigh of relief. Japan is holding up about 600 points. Australia as well looking quite okay. Hong Kong is actually holding up. And the GIFT Nifty is indicating about 100 odd point uptick for us. So that's not all that bad. Overnight though, tech stocks once again struggled. You had the likes of Apple, Nvidia, Tesla. They were all hunkered down. Healthcare, energy, staples, they were all the ones which actually outperformed. Having said that, the knee jerk was felt across asset classes, not just equities. So WTI as well eases a little bit. You had the US 10-year yield though, that's also trimmed losses. It's holding about 4.55% now. So that's pretty much the narrative right now when it comes to the market cues. For our markets, let's talk about that now, because we seem to be following a very different trajectory. Yesterday, it was a little bit of a struggle, but one has to say that unlike the US equity markets, or for that matter, all Western markets, even Europe, we did a lot better. But are we out of the woods? It seems like Saturday, the budget reaction was just pretty much a one-off move.
So Aisha, things are not adding up in terms of pockets of strength. While you can make a case that, okay, there is no pronounced weakness in benchmark indices, you cannot make a case that, okay, large amount of event risk is behind us. Everyone thought, like I said, that there are these series of calendar events, and once you come out on the right side of the event, which is what we've done, budget was good. The tariff, which in a sense everybody saw coming, looks like it would be much more measured and diluted based on the evidence of news development last evening. Even Fed again has been very consistent, but the markets are not showing any, I mean, index per se versus the broader market per se, it's a completely divided market. Now, what I like about the market is the fact that there is support at lower level. What I don't like about the market is that the desire to buy, I think, is not there. Bad news is still getting stocks where news is bad or the update is poor, those stocks are getting hammered out of shape. Good stocks are just not getting recognized. And while Nifty is holding on brilliantly to the key levels, it is not making any kind of an headway in either direction. The other concern for the market is that the FI selling is intense, and the DI selling now seems to be getting much, DI buying now seems to be getting much lower. So now that's the FI selling. The number post budget also has gone to as high as 4,000 crore. But if you map the FI buying, FI selling versus DI buying, the gap now seems to be increasing. And you don't want to be in a situation where the DI, who's been the back support of the market, their selling in a sense is increasing. So it's not a market where you could say that, okay, it's time to buy the risk, because the FI short position is still the dominant feature why this market is not going higher, and it's been so relentless. You know, we all knew that FIs were buying, selling, and DIs were buying, but that gap is now becoming increasing, which means that at net level, the markets at institutional level in the cash market are witnessing outflows, and which is not a great situation to be in.
Yesterday, the sell figure from FIIs was larger than the DII buying. So at some point, it's going to hit us hard. But again, I think, that confusion in the market still persists. I don't think anyone can take a directional call just yet that whether it's capex or it's going to be consumption, both in the momentum portfolios and in the core portfolios.
So I think a lot of collateral damage in capex stocks is over. And if you just add up the maths now, it is not that capex in India is not going to grow at all. I mean, the government data is that the capex for FY26 will be 10% higher than what has happened in this current, or what in a sense would be the number for this year. That is not a bad situation to be in, point number one. Point number two, not everything in consumption is good and great, because for some categories the delta may just not be there. There is going to be some change as this 1 lakh crore which comes back into the system. Obviously, it will have impact on low ticket consumption items, which is that if you assume that on an average 5,000 to 7,000 rupees gets into Indian consumer, the taxpayer here, we're looking at about 1 crore taxpayers, not everything will grow. But yeah, low ticket items, whether it is eating out, dining out, maybe travel, maybe a bit of hospitality, maybe a bit of binge buying in apparel, those categories will do well. So yes, there is merit in looking at some categories, but to have this blanket view that, okay, the capex cycle is over and consumption cycle will only go higher, I think would be a very naive kind of an approach. A lot of collateral damage has happened in some of the capex stocks. You should hunt for bargains. Similarly, a lot of consumer stocks have got re-rated and they're not going to go up further because P multiple are expensive. So maybe you want to just clean some of your so-called consumption stocks which have not gone anywhere in this entire rising tide phenomenon. So the numbers tell you a different story. Markets are markets, they may act and react in the short term, but I think this entire extreme selling in consumption and extreme excitement in consumption, I think extreme selling in capex and extreme excitement in consumption, I think somewhere will narrow down.
Yeah, that in any